From the opinion pages of the Wall Street Journal, this is Potomac Watch.
The remarkable U.S. economy keeps rolling along with a blowout third quarter in which gross domestic product grew 4.9%, and the price level fell as well over the third quarter. How do you explain this amid rising interest rates and slower growth around most of the world? And is it a sugar high that won't last? Plus, the United Auto Workers strike a deal to end their walkout against Ford. The union is claiming a big victory with wage increases and an end to the tiered pay system for new workers that it accepted in 2008. The union is still on strike against Stellantis, which is the former Chrysler, and General Motors. But did the strike strategy work for the UAW? Welcome, I'm Paul Gigot, editorial page editor of the Wall Street Journal, and I'm here with my colleagues Alicia Finley and Joe Sternberg. Let's get to the growth third quarter report first. The economy has defied predictions of recession all year, and in the third quarter, it's fair to say at 4.9%, it's booming. Joe, consumer spending was strong. Investment was also up, though a lot of that was built up in inventories. How do you explain this strong report?
I mean, let's be clear, it's good news. And it's important to say that because we've gotten so accustomed to worrying about the economy that there is always this temptation to kick the tires or second guess a little bit, and we can do a little bit of that. But I mean, I think that the fact that personal household consumption in particular has been so durable and contributed about half of the GDP growth in the quarter, I think is a testament to the resilience of the economy. It's a result of the fact that the labor market continues to be quite resilient, so people are working. It's also perhaps a function of the fact that the Federal Reserve has succeeded in getting inflation more under control than it certainly was this time a year ago, which is certainly very good for consumer confidence and people's ability to go out and spend. So I think that there are definitely some positive tailwinds that you can see in this report, and some of the benefits of the fact that inflation is coming under control.
On the inflation point, the price index for the quarter increased 2.9% compared with 2.5% the previous quarter. That's the general level, but the core, which excludes food and energy, increased only 2.4% compared with an increase of 3.7% in the second quarter. So that shows real progress on prices, Alicia, and that's consistent with some of the other evidence we see about falling disinflation, not falling prices, but a slowdown in the increase in prices.
Well, I think that's right. And you've seen that in the CPI reports that have come out recently. And some of that is, obviously actually due to some of the supply chain kinks from the pandemic getting worked out finally. Some of it is due to the monetary policy. Some of it's due to a little tighter fiscal policy, less transfer payments going out. Though I also think that some of the increase in consumer spending that we're seeing, or the boom or supposed boom that we're seeing, is partly as a result of consumers aren't saving as much. The savings rate was only about 3.8% in the last quarter compared to 5.2% in the second quarter. And you've also been seeing a lot of reports, including from the Fed, that people are charging more on credit cards. And so I'm not really sure if this consumer spending is sustainable over many years, let alone future quarters.
Do you think that consumers have spent down all of the pandemic transfer payments?
So there was a report out from the San Francisco Fed. They estimated that there was still about $500 billion in excess savings. And again, this is a very fuzzy number. There have been different estimates from different analysts, but there was about $500 billion in excess savings still as of this summer. And they estimated by the end of the third or fourth quarter that it would finally be exhausted. But you also have to consider the long and lag effects of some of the low interest rates during the pandemic, which allowed people to take cash out of their homes and also refinance at 2 to 3% interest rates. And I think that was actually estimated in another study that to contribute to about $500 billion in extra savings. And again, because of the lower refinance rates or lower amounts that people are paying on their mortgages every month, that is going to continue to carry forward an additional spending power.
But sometime the music stops, and that 3.8% saving rate for the third quarter is really low. That's down. I mean, that's an interesting sign. It suggests also you see reports that auto loans, more of them are underwater, and people are having problems with those, and then credit card rates too. Now, the overall consumer debt picture has been pretty good for some time and much better than it was in 2007, 2008.
Well, that's partly also because the mortgage rates have been so low for so long, and then those carry forward for the duration of a mortgage, 30 or years or until someone sells. And so that's actually helped to keep the default rates and delinquencies low, is because these payments are actually quite affordable because of the low mortgage rates. Against the student loan payment pause that has just finally ended after 2.5 years, that also contributed. And again, those were delinquencies before the pandemic were around 12%. Now the Biden student loan, these soft kind of forgiveness plans that allow borrowers to cap their payments at around 5% of their discretionary income. Now that's actually kind of a stimulus program in itself, because that's going to save people hundreds of dollars every month, again, going forward. So I think that's a big reason why the defaults are low still. Consumers appear to be in good shape. But as you pointed out, I think subprime auto loans are now their highest, or default rates are at their highest in a decade.
So question, Joe, going forward is how sustainable is this? Nobody thinks we're going to get 4.9% growth again in the fourth quarter, but, how far is it going to fall? We particularly see higher long-term bond rates that have popped up in recent weeks, the 10-year bond near Treasury, near 5%. That is going to have an effect on growth over time. That's an actual tightening of monetary conditions. You got mortgage rates now close to 8% across the country on average. That's going to affect the housing market. Some other things, China has been slower going than people thought. Germany looks like it may actually already be in recession. But I have to say, there have been predictions of recession before. I've been listening to them for 18 months, and it just hasn't happened. But what do you think about going forward?
Well, I think you can definitely see some yellow lights, maybe even a red light or two in this report, that I think if anyone in Washington were paying attention would be the things that they should pay attention to. So, for example, business investment was a bit of a weak spot in this report, particularly when you look at business equipment. That is concerning because I think that Washington would really want to encourage more of that kind of activity in order to make sure that the employment and the wage growth will continue. Because, remember, for the consumption side, you can't separate that from the labor market. And for all of the factors that Alicia was talking about a moment or two ago, those concerns about debt are not evenly distributed across all households in the economy. And you really need to be looking at things like business investment, wage growth, job creation that will be of particular benefit to lower income households that without that kind of growth in future quarters will really start feeling the pressure of some of these pressures that right now might be starting to weigh on their consumption.
And of course, that business investment, Joe, that is an enormous influence on productivity, which are the ultimate driver of wage increases, because you need investment in equipment. You need new business investment to be able to drive productivity gains in companies. And so the decline in the third quarter was a bit of a surprise. The other point is inventories, which really did build up quite a bit, contributed an awful lot to the GDP growth. And inventories, of course, when you build them up, they have to be sold. And we don't know how sustainable that will be. Alicia, what about the point of how much of this business investment is driven now by government subsidies? And I'm talking about the Inflation Reduction Act, which had enormous subsidies for green energy, a whole panoply of favored climate-related investments. You have some of the infrastructure bill also going online here, contributing to construction. How much can we determine is from government-driven investment?
Right. So there's also the CHIPS Act, which also contributed or is going to start contributing. But a lot of the chip makers have also planned factories and are also beginning construction even before some of the money goes out.
Not the potato chips,
No,
but
right.
computer.
Semiconductor, computer chips. And you've seen just kind of a boom in investment in anticipation of that money getting doled out. Some of that may have actually occurred anyways, just because suppliers and companies like Apple are actually trying to shore up their supply chains and protect them just in case there is geopolitical problems or if, in case China invades Taiwan. So some of that, again, may have happened anyways. But I don't think you can discount the effects of, the infrastructure bill, which is about $600 billion over 5 or 6 years. And again, that increases demand for all, tractor trailers and all kinds of construction equipment. So it's actually a little surprising that you haven't seen more of an increase this last quarter in equipment investment. There's also been, again, the Inflation Reduction Act. That money is, a lot of that is in terms of tax credits and, again, incentivizing companies to invest in various kinds of renewables, wind, hydrogen, carbon capture, goes on and on. The Goldman Sachs analysis estimated there would be about $1 trillion, and that would actually drive $4 trillion in overall investment. So they estimate at least they would have a quote-unquote multiplier effect of, 4 times.
So $1 trillion in total subsidies, but that's not 1 year. That's plays
that'd
out
be
over
through the decade, right? And then they estimated that would drive, again, $4 trillion in total spending. It's about $3 trillion on the private sector side. And I'm a little skeptical of one, the multiplier effects, but I do think that's contributing or at least bringing forward some of the investment. But I also think it's distorting or shifting where it's occurring. So maybe we're actually, companies or investors are putting more money into construction, wind farms, these hydrogen hubs, but less money may be going to other places. We've seen, there has been an increase in oil and gas production in the U.S., but there's actually, if you look at the numbers, there's actually been a decline in development or construction of oil and gas rigs. So I think that it could just be kind of shifting the investment flows, not just increasing them temporarily.
And of course, it matters whether or not those investments that are subsidized and therefore directed by government, in a sense, pay off, whether they in fact are going to be successful. Some of these technologies, like carbon capture, may not actually pan out.